The Indian rupee has been experiencing a period of depreciation against the US dollar, recently falling below the 87 mark. This decline can be attributed to a complex interplay of global and domestic factors, which are important to understand from a UPSC exam perspective. Global factors, strengthening US dollar. The US dollar has been strengthening against major currencies due to a robust US economy, rising interest rates, and its safe haven status amidst global uncertainties. This makes the dollar more attractive to investors, increasing demand and its value. Global economic slowdown. Concerns about a global economic slowdown and geopolitical risks, such as the ongoing Russia-Ukraine war, have led to a risk-off sentiment among investors. This often results in capital outflows from emerging markets like India, putting downward pressure on their currencies. Rising crude oil prices. The surge in global crude oil prices has increased India's import bill, as it is a major importer of oil. This rise in import costs puts pressure on the rupee, as more dollars are needed to pay for the same quantity of oil. Domestic factors. Foreign portfolio investor. FPI. Outflows. FPIs have been pulling out investments from Indian equity and debt markets due to global uncertainties and rising interest rates in the US. These outflows reduce the demand for rupees and increase the supply of dollars, leading to depreciation. Widening trade deficit. India's trade deficit has been widening, meaning that the value of imports exceeds the value of exports. This necessitates more dollars to pay for imports, increasing demand for dollars and weakening the rupee. Inflationary pressures. High inflation in India can erode the purchasing power of the rupee, making it less attractive to hold. This can also lead to capital outflows as investors seek better returns elsewhere. Impact on the Indian economy. Increased import costs, especially for essential goods like oil. Higher debt servicing costs. For companies with foreign currency debt, a depreciating rupee increases the cost of servicing that debt. Boost to exports. On the positive side, a weaker rupee can make Indian exports more competitive, potentially boosting export-oriented sectors like IT and pharmaceuticals.